Again to Tim Bigham's Big Time Options, Edges and Hedges. Be taking a look today at another of our series on why IV matters. This one, a then and now on Amazon. Taking a look at a neutral iron condor, a bearish call credit spread, and a bullish put credit spread. How much has changed between now and then without the stock price changing? So let's jump in and take a look. So here's the comparative basically from today. Here's we're hovering just above 170, going back to early August when the stock was basically at exactly the same price. What has changed? Implied volatility. You can see implied volatility now at by far the highest level we have seen over the past year, and really since the height of the COVID crisis. Stock obviously getting deeply oversold here. How low will it go is the million-dollar question. But here's some ways to take advantage of it, whether you have a neutral, more like myself, a bearish, or a bullish viewpoint. So let's jump in and take a look. First, pulled off the options chain from basically the close yesterday to back the last time the stock was here. So in this case, we're taking a look at a iron condor trade selling the 205-210 call spread. So roughly about 35 points out of the money on either side here. So giving us plenty of cushion, right? And receiving a little over $1 net credit, $1.14. Here you can see the stock at 170.66 at iron condor for $1.14 net credit. As we said, about 35 points of upside and downside cushion, or roughly a little more than 20%. And the IV, the average between the put and the call, and we do have a deep skew on this between that, but certainly IV on both the calls and puts exploded lately, over 61 on average. Days to expiration, 38 days. So that return on risk, in other words, what we can make on what we're risking, and we always like define risk trades to begin with, especially in this market environment, plus with plenty of cushion. We don't have to be right, just avoid being really wrong. We got 20% for the stock to move before one of the sides of the trade gets in trouble here. So our potential return on risk, if over the next 38 days Amazon stays basically well behaved, closes above 135, right, or below that 205 level, our return on risk would be $1.14. We'd be risking a little bit less than $4. Only one side can finish in the money. 5-point wide spread, that's our max risk, right? So our return on risk, a little bit more than 29%. We'd be risking 386, which is our max loss, $386 per spread, and bringing in $114 per spread. Let's go back then, the last time the stock was at this price in late August. As we said, stock was at 170.80, so virtually the same price. That same iron condor, except much closer, right? Now we're looking at the 190, 195, the 150, 145, 15 points closer on both sides, right? So roughly about 8% closer to the money spread, but yet the iron condor was cheaper back then. So you'd only have about 12% upside and downside cushion on the trade. Why was it so much cheaper? IV was only at just under 30, so the IV has absolutely exploded, which has given us the ability to move further away from the money, get a bigger cushion and a bigger credit, and lo and behold, days to expiration. Back then I took a look at a 50-day to expiration trade. Now we're looking at a expiration that is 8 days, so certainly a much shorter time frame as well. So this is what we look to capture, right? That we can get a bigger cushion on the trade, further away from the money, a bigger net credit, a bigger return on the trade in a shorter time frame. So everything lining up on this trade to take advantage because of this huge spike in implied volatility from under 30 to over 60 here, and the return getting close to 30% now, before it was under 25%. So this would be a more neutral trade, right? You're simply selling both sides of the market as far as putting on the trade with 20% cushion. You're really just hoping for the stock to remain well behaved. If you're a little bit bearish on Amazon, right, and you don't think the stock is going to go much to the upside, right, at all. Here is that call credit spread. Now I took a look at the 200-205 call spread, right, trading right around 85 cents. Upside cushion with Amazon right around 170.66, about 17%. The IV on the trade approaching 50 days to expiration, so we said 38 days. So your return on risk, right, you're risking $500 to bring in 85 bucks, but your risk total is $415 max loss, potentially make 85 bucks, right? So return on risk a little over 20%. You have that very nice 17% upside cushion on the trade. Again, days to expiration 38. Fast forward to back then, I guess, or go back to back then, right? Stock, as we said, virtually at the same price. Now we're looking at the 190, 195 call spread. So 10 points closer to the money, 10 points less upside cushion on the trade, right? Yet the credit is less than what it is now, right? So you're able to get 10 points further out of the money now, get a bigger credit, right? Getting 85 cents versus only about 55 cents back then, right? Why? Because IV 27 now almost double that as it's near 50. Days for expiration, as we said, more. So you have a longer time frame to have to wait. The return on risk, only about 12.5%. If you did it now, it would be well over 20%. So that's a way to take advantage if you have a somewhat bearish outlook on Amazon. If you have a bullish outlook, same sort of scenario, selling out of the money put spread, right? We're looking at the 140, 135 put spread, about 30 points to the downside, right? Trading right around 75 cents. So your downside cushion, almost 18%. The IV, as we said, the skew is certainly steep, and so out of the money puts trading at a higher IV, which helps a little bit. Remember, we're buying a put as well as selling it. So our days to expiration is always 38 days. Your return on risk, right? You're risking 425 bucks, right? 5-point wide spread, bringing in 75 cents, so 425 at risk. Could make 75 if Amazon closes above 140 come May expiration in 38 days. Taking a look back to then, right, stock, as we said, virtually at the same price. The put spread, we're taking a look at the 150, 145, a 10-point closer to the money put spread. So now we have 10 points more cushion, yet the credit we receive now is basically almost half of what we could back then for a much closer to the money spread. Downside cushion now only about 12%. Why? Because the IV is less than half of what it is now, right? Longer time frame too, as we said, 50 days to expiration. So our return on risk, well under 10% back then, whereas now it is more than double that at over 17%. So this is a way to get a bigger cushion on the trade, right? Further away from the money. You can have the stock go against you much further, get a bigger net return on the trade, right, from both a actual credit and percentage basis, and have a shorter time frame on the trade for it to happen. So all three things certainly lining up. The covered call scenarios, if you're looking at covered calls, certainly those fit the same sort of thing. I kind of put together a quick synopsis here, side by side. Top one here is that iron condor, kind of a neutral trade, right? So basically the stock at virtually the same price at 14 cents difference, no big deal for a $170 stock, right? The iron condor back then till now, 19 cents more expensive now, but remember, we're closer to the money back then than now. We only had about a 12% cushion back then. We have over 20% right now because our strikes are further out of the money, right? But yet we're getting a bigger net credit. IV is the reason why IV moved from that kind of over 60 IV, right, to it was back under 30. So that huge jump of over 32 vol points, basically IV doubling, means we can get further away from the money, get a bigger net credit, and again, all in a 12-day shorter time frame, able to make almost 6% more with a bigger cushion in a shorter time frame on the neutral iron condor. On a bearish call credit spread, right, same sort of scenario there. We have a bigger cushion, right, we have a almost 6% bigger upside cushion, right? We're moving from that 190, 195 to the 200, 205, right? 10 point further out of the money, right? Or almost 6%. Yet we're getting a bigger credit here by almost 30 cents, right? On the trade. Why? Because the IV has exploded again, almost doubling on the call side, less days to expiration. So we have a bigger cushion, bigger credit from a percentage standpoint with less time, can make almost 8% more now versus back then with a 10-point bigger point cushion, almost 6%, right? And increase our return by almost 8%. And then finally taking a look at that bullish put credit spread, exact same scenario. Again, the stock virtually the same price. The put spread has basically almost gotten twice as much as it was before, yet we are moving 10 points further away from the money. We were short the 150, 145 back then. Last time Amazon went this price. Now we can do the 140, 135, get a 10-point bigger downside cushion. Why? Because the IV has exploded again, basically doubling from back then till now by over 40 basically vol points. And we have a shorter time frame, so we're able to sell a put credit spread bullish, have a much bigger cushion, right? Have almost 18% now versus 12% back then, right? 10 points further away, but yet get almost twice the credit or almost a 9% bigger return again. Getting a bigger return with a bigger margin of safety, that bigger cushion to a large degree in a shorter time frame, all because of this jump in implied volatility. So this is a way to take advantage of the implied volatility we see in the current market environment in a defined risk way. All these trades have defined risk, right? You know your loss when you put on the trade, right? And then the nice thing is if you have to hedge for whatever reason, if the trade starts to go against you and you want to hedge, for example, selling a call spread, if you initially sell the put spread, selling a call spread would hedge the trade off, turn it into an iron condor. The fact IV is high now, you get that bigger credit, a bigger hedge benefit as well if need be. But anytime I think you can get this kind of edge, right, getting further out of the money, getting a much bigger credit, having that bigger, if you will, area for it to go against you in a shorter time frame certainly makes sense. So that's what we do here. Look for those edges, then put on the hedges. So until next time, as always, here's a good